Hello and welcome to the Athena Capital Advisors video series. Today, Eric Rawlings, Vice President of Research at Athena, will be discussing our 2016 Strategic Asset Allocation Model.
For taxable portfolios, the notable shifts are an increase to domestic equity and foreign equity, and that's primarily funded by reductions to hedge funds and commodities. For tax-exempt, the primary shifts were an increase to fixed income and foreign equity as well, and then reductions to private equity, private real estate, and commodities. I think something else that was sort of interesting as we went through the process is the changes within the sub-asset classes. And again, this gets at the correlation benefit that we expect from the asset classes. And so, as an example, within hedge funds, we saw a reduction to equity long short and credit strategies, as they tend to have common factors to your long only strategies. And then a sizing up of our quantitative and global macro strategy is that strategy tends to have less sensitivity to your traditional sort of market factors, so a less correlated stream of returns. Two broad categories that drove these shifts. One was process changes this year, and then the other was our risk factor forecast. So in terms of process changes, there were two significant shifts. One was the incorporation of two starting portfolios. We chose starting portfolios particularly for our taxable clients and our tax-exempt clients. And this was really in recognition that no single starting portfolio fit exactly what we thought was appropriate for an Athena client. And so rather than using a single starting portfolio, we decided to use two to sort of tease out the unique information in each of those starting portfolios. The second process change was related to incorporating sub-asset class relationships. So this is to take into account that sub-asset classes that are in nominally different asset classes may share common factors. So I think emerging market debt and emerging market equity are a good example of that, where they are in nominally different asset classes, but their underlying drivers are very similar. And so by incorporating the sub-asset class relationships, we take that into account. So overall, the risk factor forecast came down. This is really a statement or representation of the limited value that's out there. We have low interest rates even after the Fed rate increase in December. Inflation has been low, although increasing lately, but still at very historically low levels. And then credit spreads are still reasonably tight, although more attractive than they were maybe 12 months ago. And then equity valuations, although we did have some volatility through the back part of last year and into the start of 2016, we still have equity valuations at elevated levels. So I don't think we're at the 99, 2000 sort of euphoria range, but certainly on a historical basis above average. It's important to remember that this is our best thinking of a 7-year outlook, or the asset allocation that we think over the long term can drive strong risk-adjusted returns for our clients. It's really the short term where our Athena's tactical views, portfolio management, and risk management come to bear and will allow us to either buffer the portfolios in those risk-off environments, but then also be able to capitalize on dislocations when they occur.